Hello everyone, and a big welcome to RJ Sanderson TV, the November edition. We are in the middle of spring. The weather's fantastic now, Roy, and I suspect the mood in the community is starting to become a little bit more positive. How are you, Roy?
Yeah, very well, Dave. Welcome. Thank you. Yep, no, feeling really good. Spring carnival time in Melbourne. It's a wonderful time to be around Melbourne. Weather's perfect.
Spring carnival sometimes means that some people have a little bit more money in their pockets. A lot of people don't. But what is the mood like in the community at the moment? Because it's a turbulent time out there. There's lots of change. There's lots of volatility. But I also sense, and I use that term that Brendan Bolton coined last episode, some green shoots in the economy. I sense that there's a little bit of optimism starting to pop out now that the weather's improved.
And I think, Dave, as we go through today's presentation, we will see that those green shoots have definitely come along. Things are a little bit better.
Well, let's get into our first green shoot as part of our news headlines, and that is the inflation rate, Roy, because for the first time in a long time, there is a 2 in front of the number that has been presented to us for the Q3 inflation rate. 2.8%, now back within the government's targets of 2 to 3%.
Yeah, it's correct. So it's under 3%. The reality is, though, that there's approximately 0.3% relates to the energy rebate. So our power bills are lower. And if you added 0.3% to that, you're just outside the band, which is possibly why the Reserve Bank did not reduce interest rates recently. Longer
term, you can see where the inflation rate sits as we look at the next graph, because it is now, as we said, below or within the government's target of 2 to 3%, but you can still see it's on the kind of high end of where I suppose the average has been over the last 30 years or so.
Yes, very interesting that they didn't decrease interest rates, and I think this is the main reason they didn't. I think they just want to see that it gets well into the middle of where their target is rather than right at the top end.
So the interest rate, as you mentioned, is unchanged at 4.35%, and it has been unchanged now for quite a while. The Reserve Bank meeting on Melbourne Cup Day, I might add, Roy, and leaving that interest rate unchanged. Now, I think there's a few things. As you said, inflation appears to be under control, but perhaps there are some false markers within that inflation rate that they are watching. And I think the other thing that they're watching is the outcome of of what happens as a result of the US election, Roy. So some economists have talked to the idea that the Trump administration, one of their policies or one of their cornerstone policies is to bring in a tariff that may create inflation, or that on paper would have the byproduct of creating inflation. That inflation therefore may flow back to Australia, and therefore a conservative outlook with interest rates for the Reserve Bank. So I think it's a watch and see, but it sort of does feel like at the moment now that inflation is under control. Hopefully the next move for interest rates is down, not up.
I would think so. My estimate is that the next meeting, which is 9th of December, I doubt there'll be a change in interest rates at that meeting. I think they don't want to inflame inflation just before Christmas and everybody go on Christmas spending spree. So I think the meeting after that is February, and I think that's when we're going to see our next interest rate reduction.
Hot off the press, we have the consumer confidence numbers, Roy, and it is a stunning number of 94 for November. That represents a 5.3% increase from October, and it's the highest level it's been in 2.5 years. So despite turbulence out there, despite uncertainty, it appears that people, I think, are in a better position to plan and therefore in a better position to feel confident about the economy. It sort of feels like they are, well, as we use that term, green shoots, they're starting to see a way through now that inflation appears to be curtailed and interest rates have stabilised at that 4.35%.
Yes, and it makes your green shoots comment last month look very, very good, doesn't it? You predicted this, that things were looking a little bit better with green shoots, and this survey was pre-Trump election.
Yes, so I think it will be interesting to see what consumer confidence does after or in the next month, considering these numbers don't factor in the Trump administration election. And we're going to look at some of the potential short-term indicators that may suggests that consumer confidence will continue to increase because at the moment, post-election, all the economic indicators are positive. There's a tease of what's to come regarding the numbers and markets following the election of the Trump administration. But we'll get to that one in a moment because business confidence is a number that we also like to look at, Roy, and it's another one that's had a stunning turnaround, this time the October number, which is up to number 5, which is a number of 5, which is a turnaround from -2 where it was. So what that means is businesses are more optimistic than pessimistic, and there's been notable increases across all industries except for construction and retail. So some of those industries will include mining, tech, resources. So they may be, interestingly, Roy, they may be the industries that are most affected by a potential US tariff. So I think it's a wait and see as to how that number reacts with the next instalment of the business confidence number. But in saying that, there is also a lot of optimism about a deregulated approach that will open doors and opportunities for businesses. So I think potentially the two could counter out, and I think you'll see that business confidence number continue to increase.
Yes, what an extraordinary turnaround. 12 months ago, that was -8 to a +5. So that's a fantastic turnaround just recently.
Growth is on the agenda, as always, Roy, and the GDP outlook is still struggling in Australia. You can see that it's at a quite a low point comparatively to where it's been since 30 years ago.
Yeah, and this is an interesting slide because the challenge for the government or the Reserve Bank is we want a soft landing. If we leave interest rates at the current levels for too long and GDP growth continues to decline, we don't want it to go into negative. 2 negatives means a recession. We certainly don't want that. So the soft landing is the absolute challenge. And that's why I'm expecting February will see a reduction in interest rates just to ease off the GDP reductions.
I think this next chart that you've discovered, Roy, is a beauty. It kind of ties everything together, and it's the household income consumption and savings ratio. You can see there at the top, it's got the consumption number, which is decreasing. It's got the disposable income number, which is increase or getting back to square. So people are starting to live more within their means, and the savings ratio is flat now. So talk us through your analysis of this one.
Yeah,
Roy.
so consumption is dropping. Disposable income, we don't have any because it's at 0, and we've spent all our savings that we managed to accumulate during COVID. So we're not spending a lot of money, which might explain why retail aren't feeling so confident in the retail area. So this says that the soft landing for GDP is quite important because all these factors indicate we don't have a lot of money to splash around.
Yeah, I like this graph for a number of reasons, but I think you could mount a case that this looks like a turning point. Like everything has kind of zeroed out there. So what happens next is probably going to be the byproduct of regulation and optimism. So, you know, we're at net zero. We've got no money. We've got no savings. It's like a clean start. We're starting again. And I think if you think about inflation being under control at 2.8%, and if wages are now outpacing if wage growth is now outpacing inflation again, which it hasn't been over the last couple of years, I think you can start to see why consumer confidence is starting to increase. Because if inflation outpaces wage growth, people have less money in real terms than what they're earning. So it is harder to live. But if wage growth is outpacing inflation, then and things are at 0, then maybe people might be able to start accumulating some savings. Maybe people might be able to start spending a little bit more of their money. So I feel like that graph shows that we're at a turning point. We're at net zero for everything. And whatever is ahead now is more manageable because inflation's under control and interest rates are stable.
100% agree. This is the next couple of months are going to set up what 2025 is all about.
Speaking of what is going to set up 2025, let's have a look at the stock market and the ASX 200's performance over 2024. And look at that, Roy, 18.9% return on investment over the last 12 months, it's been a stunning year for the ASX 200.
Now, I just want to go on record, Dave. We predicted this. Last year...
Hang on, Roy. You predicted this. Well done to you. Well done to you.
Last year, 12 months ago, I was asked, what do I think the stock market will do in 2024? And I didn't state a percentage. I went back and listened to the show just to be sure. I actually said it will be a good year, and then I corrected myself and I said it will be a great year. Well, that is somewhere between great and awesome. Nearly 19% return.
Almost at record highs, and we have reached record highs during that year, Roy.
And I just want to add, that's the average for the top 200 in Australia. Imagine what you could make if you were seeing a wealth manager who would pick out the best 10 or the best 20. That 18 could be 24, 25, 30. You just got to get the right advice. Just don't go wild and buy a bit of everything. Get the right advice before you go into the share market.
rjsanderson.com.au if you want to get some advice from a wealth manager. Roy, I suppose the question that begs is there a correction coming? And, that's what everyone wants to know. They want to know, am I buying at the top of the market? Because if I buy at the top of the market and a correction comes, I'm already at a loss on paper. I've lost money on paper. So the question becomes, are we at the top of the market? Is now a good time to buy?
Well, the share market over the long term, the graph shows that it is certainly volatile. We have...
this is the 20-year chart that we're talking, Roy?
Correct. 20-year chart indicates that we have some drops, and I've put little arrows down when we've had those drops, but you only lose money if you sell when it drops. And yes, we're at an all-time high, but I think there's more in the market because when we have a drop, there is something significant that causes it. And I don't see what that might be on the horizon. So I think we have at least another good year in us. I can't imagine it being another 19%, but I suspect it might be 12 to 15%. And if there is any correction with one of those little down arrows based on the cycles I've tried to identify there, I think it would be late, at least past the middle of next year to late next year. So I'd be certainly staying in the stock market. I'd be getting the right advice. And you only lose money if you sell.
You mentioned that you can't see an event ahead that may impact that. And I think that's a really important point to make, Roy, because maybe the average punter at home will be saying, well, what about the Trump election? What about the Trump administration? And I think there's a very clear argument to that, and that is that people who trade markets have factored that in a long time ago. The election polls suggested that the result could go either way. They would have hedged against both results. So I think the idea of a Trump administration, coming to fruition was factored into the stock market a long time ago. And I think that's why we see no notional negative effect on markets, particularly starting with the ASX 200 over the last week. So you can see this graph. 6th of November was the election, and since then the market is slightly optimistic, slightly higher. And if you look at the US market, well, the Dow Jones up 2.5%, the S&P 500, I should say, up 2.5%, the Dow Jones Industrial Average increasing 3.6%, the Nasdaq also climbing 3%. And you take Tesla, the electric car company of Elon Musk, who a close ally of President-elect Donald Trump, that was up 15%. So obviously the US market has reacted optimistically to the news. Another market that has seen some pretty extreme movement over the last week since the US election is Bitcoin. Have a look at that, Roy. About 28% is the increase of Bitcoin over the last week. It wasn't that long ago, Roy, that you and I were sitting here talking about Bitcoin at a price of around $30,000, $30,000 US dollars, now up around the $88,000 US dollars. Quite a staggering amount for one Bitcoin now.
Yes, it is staggering, and I often get asked about Bitcoin. Is it a good thing to buy? And I will respond with, do they pay a dividend? No. Are there bricks and mortar that you can touch and feel and see? The answer is no. So it's all about capital growth and about demand. So as long as you've got more people wanting to buy it than those that want to sell it, you will see it increase in price, which is what we have just seen.
Very interesting, Roy. So that's the stock market, and that's some of the economic indicators on that side. Let's have a look and change pace at the property market, and starting with dwelling values over the last 12 months. What have we seen there, Roy?
The average across Australia is a 6% growth in 12 months. So certainly not as good as the stock market, but this is dwelling value increases. But if you look at Perth was 22%. How great was that? But you look at Melbourne was negative 1.9%. So although the headline might be 6% across Australia, the reality is pick the market because Melbourne has gone backwards in the last 12 months.
The median days on market also tells a story.
I put a little arrow at the bottom here because the only state or town, city that's gone worse over the last 12 months is Melbourne. 27 days on market on average last year, now 41. So that has blown right out, despite the fact that the average is 33 compared to 27. So Melbourne is certainly the one that's not doing as well as the rest of Australia.
In terms of growth in rental prices, what are we seeing on that one, Roy?
Well, we're still getting growth in rent. Rents are going up by 5.8%, which historically is quite high. They're not getting the 9 or 10% or close to 10% that we were getting since COVID. So I'm talking to real estate agent clients regularly, and they're saying that they can feel the heat has come out of the rental market just a little bit. So that growth is coming back to something that's more reasonable, and the average being 5.8% growth in rent over recent times, and I think we're going to see slight easing of that going forward.
So it's interesting because obviously property investors can make money in multiple ways. They can make money off the capital gains. They can make money off the rent. So the rental price holding or increasing by 5.6% may be outweighed by the capital loss that we've seen in dwelling prices. Is now a good time to enter the property market, do you think, Roy?
I think there's going to be some bargains available in Melbourne, especially the holiday market where mums and dads are selling the holiday home, or people are indicating they don't want to have an investment property because of some of the taxes and compliance costs in Melbourne. So if you are thinking about property, and I've had very few clients come to me in the last 6 months to say that they are thinking about property investment, but if you're sitting on the fence, I just keep my eyes open because I think somewhere early 2025, in the holiday destinations like the Mornington Peninsula, Country Victoria, I think there's going to be some great bargains available.
And I think one of the favourable conditions for those that are looking to go into the market is the vacancy rate at the moment, because despite the fact that there has been people exiting the market, the vacancy rate seems to be holding pretty strong. Yeah,
well, currently in Melbourne, 1.5%. The average for 5 years just prior to the pandemic was 1.9. So we have, you can look at that and say that's only a 0.4 drop, but that's as a percentage on top of it, that's 20% less houses. So that's quite a lot. And look at Perth. The average was 5.8% vacant 5 years average. It's now 1.2, which might explain why Perth's house prices have gone through the roof.
Investor finance is a good way of looking at whether people are entering the market at the moment. Roy, what does this story tell us?
So if you look at the bottom left, in Australia, 38% is the percentage of investor finance for new finance. Now, in Melbourne, it's 31%. But what's interesting is over the last 10 years, that has dropped by nearly 14%. Now, that means there's 14% less investors in the Melbourne market. And that's, again, I'm hammering the state government, but compliance and land tax is causing that as a problem. My concern is that 31% will continue to drop. And I think next year we're going to see that somewhere around the 25% mark, because investors in Victoria, they're just not there. You need to really have some gumption to step up and go, I'm going to buy an investment property, because the property prices in Melbourne cannot stay so restricted for much longer.
Right, we've had a look at the stock market, we've had a look at some of our economic indicators, Roy, we've had a look at property. Now it's time to look at tax. One of your favourite topics, Roy. Let's get into a tax tip. Kick us off with a low income earner tax tip, Roy.
Yeah, these are for two tips. First one is the co-contribution. If you have a person in the family who earns under $45,400, then you can contribute $1,000 into your super fund and the government will put another $500 into that super fund. That's a 50% immediate gain. Now, if you have little Johnny working at McDonald's or somewhere, not a bad little gift to throw $1,000 into the super fund, because that is giving an absolute huge boost for when little Johnny becomes old Johnny. And if you've got a spouse, you can actually have a spouse tax offset. If your spouse earns less than $37,000, contribute $3,000 to their super fund, claim it on your tax return, and you get a $540 tax saving. That's an 18% gain. Now, we have a document that is tax tips for 2025. If you go to our website, contact us, we will send it out to any listeners of this show. It's about 50 tax tips that you should consider. Not all of them are applicable to every person, but you can run through the 50 and identify those that might be suitable to you.
Fantastic. rjsanderson.com.au to get in contact. We've had a couple of questions come in from the viewers, Roy, and I'm interested to see how you go with this one. I am an electrician and I live in Melbourne. I have purchased a new work utility which will be used 100% for work from a person in Adelaide. I have travelled to Adelaide and incurred costs for taxi to the airport and airfare, to all of which total around $1,500. Can I claim the tax deduction?
Oh, great question. The $1,500 tax deduction is attached to the cost of the car. The car is going to be depreciated over time at 25%. So if the car has cost you, let's say $40,000, we now make the car cost $41,500. We write that off at 25% per year. So the answer is it's a tax deduction, but not in the year you've spent the money, over the lifetime of the car ownership.
There you go. Wouldn't have picked that, definitely. Another tax question that's come in from a viewer. I have been in business for over 10 years and I'm struggling with huge debts, which are mostly money owed to the ATO. Do the ATO ever write off debts so I can get a fresh start? What is a small business restructure?
So the answer to the question, do the ATO ever write off debts to get a fresh start? The answer is yes, they do. And this is a relatively new post-COVID arrangement that the tax office will do a debt restructure. It does not affect sole traders. So if you're a sole trader, this does not apply to you. But if you're trading through a company or a trust and you have debts from past years and you can show a forecast that you can travel better going forward and make a profit and pay debt commitments in the future, then they will write the debt off or a percentage of the debt off, and that can be a considerably high percentage. It can be up to 80%. If you're interested in that, reach out to us via our website and we'll put you in contact with a debt restructure specialist.
You've got a message for tax cheats though, Roy, because the ATO have put some announcements out.
In 1 year, 47,000 tax cheats had been reported, and of those, 90% have proven to be correct. So 10% of people maybe dobbing in their ex-spouse, ex-partner, neighbour, not legitimate tax cheats. But if you do want to report somebody, there's a website you go to at the tax office, ato.gov.au/tip-off, and if you do go to that website, there's actually protection. You're kept confidential. They do want to know who you are so that you're not just being a problem person. And the common industries, building industry, restaurants, hairdressing and beauty. Interestingly, all of those industries tend to be cash related, which means that those industries, there are people who are accepting cash instead of putting it through the books. So if you do that, you might actually get reported to the tax office. So 47,000 in 1 year is a lot.
That is a lot, and I'm surprised that's actually not your rage for today, because it is now time for Roy's rage. What are you going with on this edition of RJ Sanderson TV, Roy?
Well, one of the things that has really annoyed me over recent announcements, there's a new tax, and the new tax says that if you have superannuation over $3 million, you're going to pay 15% on the earnings and contributions. I'm not against that. It doesn't affect a lot of people, but it does affect some. What I am against is the $3 million is not indexed. So $3 million today might affect I don't know the number, but let's say it's 5% of taxpayers. But if we jump 10 years down the track, that 3 million could be affecting 20% of taxpayers. So if you're going to invent a tax of this sort that's based on a cap of earnings, you must index it. And the government don't want to index it because they actually want it to affect more taxpayers by stealth, purely by bracket creep or by income creep. So it annoys me that the government introduces taxes and then doesn't index the numbers.
The final Roy's Rage for the year. A beauty there, Roy. Well delivered as always. And the final shout out for the year goes to a brand or business that we've spoken about before. It looks, it's a cracking name. I love it.
Yeah, 10 Minutes by Tractor, down on the Mornington Peninsula, a fantastic restaurant, brilliant wine. If you're looking for a wonderful dinner, I mean, really 5-star, or lunch, reach out to them. The number's there. Terrific place, very good people.
Roy, that's everything for the year. Thank you. It's our 5th year of RJ Sanderson TV, can you believe it? But before I let you go formally, 2025, we've talked about earlier in the show, I've given my thoughts that I think we're back at ground zero and that everything is centred and ready for a new chapter. What do you think 2025 has in store, and do you think it's going to be a good year?
I think in summary, Dave, it will be a good year. I think property will continue increasing at somewhere around the 6 to 7% mark. I think the stock market will continue to increase at somewhere around 15% above for at least the first 9 months. I think there will be a correction on the horizon. I'm very excited that business confidence, consumer confidence are both increasing. I think that'll continue. I think we'll have a reduction in interest rates early next year. I think retail will bounce back a little bit. I think next year is going to be a great year. So I'm pretty positive and confident that things are looking up.
Well done, Roy. It's been a great year.
Thanks, Dave.
And thanks to everyone at home for watching RJ Sanderson TV. We may see you again in 2025.